Hello, my name's Jesse McPhee. I will never sell a universal life insurance policy. I'll tell you why here in a moment. Recently, at Life Benefits, we got a promotional email from an insurance company suggesting that permanent life insurance is a great way to sustain your income when the market drops and you would have to use the principal portion of your investments instead of living off the growth. This is true. You can sustain a higher standard of living during a market correction if you use the funds in your life insurance policy instead of using the principal in your investments. But then at the end of the email, they begin to recommend a certain type of index universal life insurance policy as a way to provide these guaranteed funds. Here are some reasons why index universal life insurance can fail and hurt you big time, and why I will personally never sell one of these policies. Number one, the returns assumed in an IUL policy is not the amount that your cash value increases by. Besides, there are fees in IUL policies that can eat up more than your annual gains in a weak market. Number two, the cap on an IUL return can knock out 40% or more of the earnings you could have experienced if you had simply invested directly in the index. Number three, when the market goes through a corrective period, which, by the way, happens every 8 to 10 years, an IUL policy forfeits the growth that a dividend-paying whole life insurance policy would continue to provide. This is because index universal life insurance policies are based on renewable term insurance, and the IUL policy can't keep up with the ever-increasing costs of term. Inherently, IUL policies are designed to put the risk back on the policy owner rather than on the company. You'd be much better off buying a plain term life insurance policy and investing your money separately than with an IUL. Fortunately, there's something better. These problems can be avoided by using the right type of life insurance. Participating whole life insurance. So let's take a look at it and see what it provides. Number one, participating whole life insurance is based on guarantees backed by the insurance company, not the market and speculation. Number two, as an owner of participating whole life insurance policy, you get to share in the profits of the life insurance company after those guarantees are paid each year. This is called a dividend. Once a dividend is paid, it cannot be taken away. Number three, participating whole life insurance is based on your whole life, not just term like an index universal life insurance policy. It doesn't make sense if you want your asset to be around long term to buy term. You want something that's going to last your whole life, wouldn't you say? So here's an example of what could happen. You fund a life insurance policy at $3,010 per year for 40 years. At age 66, you need to pull $40,000 annually from your policy because a market correction just occurred and you don't want to draw the principal you've saved outside of your policy. Smart. If your policy is an IUL policy and growth takes place as illustrated using the maximum allowable rate over the past 40 years, you would have access to $0 guaranteed even though you paid $117,000 into this policy since you were 26 years old. This doesn't look good, but hold on. The non-guaranteed assumptions of this policy are $126,000 at age 66. Unfortunately, at $40,000 a year, that money isn't going to last long. It's going to run out in just a little over 3 years. After that, the IUL policy will lapse and you'll have no insurance coverage on your life. If you purchase a participating whole life insurance policy instead of an IUL for the same $3,010 a year, at age 66 you have access to $222,260 guaranteed instead of zero like in the IUL policy. And the non-guaranteed assumptions of this policy are more than double what was non-guaranteed in the IUL policy. And then remember, the dividend is paid on the participating whole life insurance policy. They can be used to offset the interest on the policy loans you need to take every year during the market downturn. This allows you to protect the principal you have accumulated in your other assets over the years instead of spending them down and taking the risk of running out of money before you die. Also, the participating whole life insurance policy doesn't lapse like the IUL policy does because there are no premiums required after age 66. But even though there are no premiums due, the guaranteed cash values and accumulations keep going up. At this point, you're probably wondering, why would anyone buy an IUL policy? Well, when people better understand how IUL policies work, like you do now, they don't. Unfortunately, IUL policies are often sold by focusing on the projected index-based returns rather than the guarantees, and people get starry-eyed. So when you're choosing what type of life insurance to purchase, remember, With an IUL policy, you're assuming the risk yourself, and with participating whole life insurance, the risk is taken on by the insurance company. So choose wisely. Hey everybody, if you would like to learn more about how participating whole life insurance and index universal life insurance work, check out this video by my sister explaining the details.